For what feels like forever, the word refinance has basically been dead. But that is changing, and it's changing fast. Even a tiny dip in mortgage rates is causing this huge wave of homeowners to suddenly start making moves. So we're going to break down what we're calling the Great Refinance Rush, who's really cashing in, and what it could mean for you.
All right, let me ask you a question, and be honest. Did you get a mortgage anytime in 2023, 2024, or even this year? If you're nodding your head yes, then listen up, because you are right in the middle of a massive financial shift. Seriously. You're the one the entire mortgage industry has its eyes on right now.
So why are they watching you? It all comes down to this number, $200. That's what people who've refinanced recently are saving, on average, every single month. I mean, that's a pretty powerful reason to make a move, right? And it's exactly what's fueling this whole thing.
And that brings us to our first section, the Great Refinance Rush. It's wild. Even the smallest bit of rate relief we saw last fall was enough to just light a fire under the market. It's pretty clear that after years of sky-high rates, people were just coiled and ready, waiting for that starting gun.
Okay, before we get any deeper, there's a key term we've got to get on the same page about. It's called refinance retention. Sounds complicated, but it's super simple. It's just the percentage of people who refinance their mortgage and decide to stay with their current lender. Think of it like customer loyalty, and believe me, it tells a really interesting story. And here's the headline number from that story. Retention just hit 28%. That's the highest it's been in 3.5 years. So you've got more than 1 out of every 4 people who refi choosing to just stick with who they know. And for those lenders, that is a massive win. This quote from Andy Walden over at ICE Mortgage Technology really just nails why this is all happening so fast. He says the market's become more rate sensitive. What he means is the market is basically on a hair trigger. The smallest day-to-day rate shifts can suddenly push hundreds of thousands of people into that zone where refinancing just makes perfect sense. So who is this person who's cashing in? Let's dig in and build a profile of today's typical refinancer. The data paints a really, really clear picture of who's pocketing that $200 a month.
And what's so fascinating is just how specific this group is. I mean, look at this. The action is pretty much all coming from people who got their loans between 2023 and now. They've got big loan balances, around $500,000, and fantastic credit scores. And they're cutting the rate by almost a full percentage point. That's how you get to that $200 a month savings. But here's where the plot thickens. Not all lenders are created equal when it comes to holding on to these customers. Just look at this gap. Non-bank servicers, think of your online lenders, are keeping 35% of their customers. Traditional banks, only 13%. That is, wow, nearly 3 times better. It's a massive difference in performance. And the story continues if we slice it by loan type. Lenders are doing a great job holding onto people with government-backed loans, like FHA and VA. They're keeping 36% of them. But that number drops to 25% for the standard Fannie and Freddie loans. And for privately securitized loans, it absolutely falls off a cliff, all the way down to just 6%. Okay, so let's shift gears. What if you're one of the lucky ones, right? You locked in a crazy low rate, 2, maybe 3%, a few years back. Obviously, a normal refinance makes 0 sense for you. But that doesn't mean you're out of the game. Oh no, there is a whole other boom happening with people just like you. And this is a really important distinction to make. On one hand, you've got the standard refinance we've been talking about, which is all about lowering your monthly payment. That's for the recent buyers. But on the other hand, you have home equity loans or HELOCs. This is for all you folks with those amazing low rates who want to tap into your home's cash value without messing with that great primary mortgage. And let me tell you, the demand for these is just exploding. We are seeing withdrawals from home equity loans hit their highest level since 2007. I mean, that's an 18-year high. So you've got this fascinating split. One group is refinancing to lower their payment, and a whole other group is taking out cash. All right, so let's zoom out. How does all this fit into the bigger housing market picture? Because honestly, while all this refinance talk is good news for some, the market as a whole is kind of a mixed bag right now. There's some really good stuff, and some stuff we definitely need to keep an eye on. Let's start with the good news. The national mortgage delinquency rate, that's just the fancy term for people who are behind on their payments, is only 3.34%. That is incredibly low, way below where we were even before the pandemic. It shows that, for the most part, homeowners are doing okay financially.
But as you probably guessed, that's not the whole story. You peel back that one layer, and things start to look a little more complicated.
See, even though the numbers are still low compared to history, foreclosure activity is ticking up. We just hit a 5-year high for new foreclosures starting. And here's the really weird part, the twist. This rise is being driven by FHA and VA loans. Yeah, the same exact group that lenders are doing the best job of keeping. It's such a market of contrasts where you're seeing signs of strength and signs of stress in the very same spot.
Okay, so we've looked at the refi boom, the home equity surge, and these weird foreclosure trends. So what's the big takeaway here? What does all this mean for you?
For me, it all boils down to this one incredible stat from Tim Bowler at ICE. Get this, a whopping 78% of borrowers, that's almost 4 out of 5 people, only shop 1 or 2 lenders before they pick one. In a market that moves as fast as this one, where tiny rate changes matter so much, that's just leaving money on the table. A lot of money. So here's your checklist, your simple, actionable takeaway from all of this. First, know your numbers, know your current rate, your loan details, everything. Second, keep an eye on things. This market moves daily, and those little shifts really matter. And third, and this is the big one, shop around. Please shop around. Get quotes from at least 3, maybe 4 different lenders. It is the absolute best way to make sure you're getting the best deal possible. And that brings us to the final question. We know that falling rates are creating these little windows of opportunity pretty much every day. The only real question left is, are you paying attention, and are you ready to act when your window opens?